about that Friday rally? Let's start there.
Well, it was actually the only day the markets were up this past week. On the week, the S&P, NASDAQ, and small caps closed down about 1%. But we did get some decent news on Friday. We got a great report from United Healthcare, a key Dow component, which added 170 points to the Dow's 658-point gain. So they reported a nice number. Also, a Taiwan Semi yesterday gave some semblance of order in the semiconductor space by raising guidance and beating on earnings and revenue. So a good report from the semiconductor sector. And finally, Citicorp on Friday, after many of the major banks reported somewhat disappointing results on Thursday, actually beat expectations. The stock was up 14%. Can't remember the last time that occurred.
So why Thursday down for some of those financials and up on Friday? Just completely different companies, the way they're run?
Well, yeah, absolutely. I mean, Citicorp has a much more global exposure than some of the other banks. They have less exposure to trading and investment banking as, say, J.P. Morgan does or Wells Fargo. But just a better than expected report out of Citicorp. And Citicorp had been lagging the other banks for most of the year in terms of price performance.
I did see a retail reading that was better than expected.
It was better than expected. On headline, it was up 1%. And stripping out autos and gas, which is important, growth actually came in much better than expected at 0.7% versus an estimate of 0.1. The only thing I would say about it is in real terms, that retail number was negative. So when you think about the inflation effects on retail sales, you have to think about units, not just price. And in this case, units were down, but price made up for it.
You mentioned inflation, so let's talk about CPI and then PPI. CPI, that number arrived on Wednesday. The expectation was 8.8, which would have been higher than 8.6. Instead, went above a 9 to 9.1.
Right, it came in at 9.1, a bad reading on all levels. In fact, the diffusion index, in other words, a percentage of the components of CPI that were up 5% or more, continues to expand, led by rents, which were up 5.8%, one of the fastest increases we've seen there. So there is still pressure on the Fed. And in fact, subsequent to that report, the thought was that perhaps they'd raise the Fed funds rate by 100 basis points at the end of the month rather than 75. But some of the Fed governors have since walked that back.
Yeah, who thought that thought at first? That just kind of leaked out and it became a big story.
Well, it is what it is. You know, I mean, people say, Jim Cramer and the rest are all arguing, let's do one and be done. Well, who knows? You know, the Fed has tried to be transparent. They're trying to be gradual in their approach because while they want to reduce demand and perhaps get that unemployment rate up to 4%, they don't really want to cause a severe slowdown in the economy.
Let's talk about PPI, Producer Price Index. That's not what things cost for the consumer. That's what things cost for anybody who wants to put a business together.
Right. And that was a double-digit increase, over 10% on a year-on-year basis. Again, a very, very strong number. And it looks like next month could also be similarly strong. So the Fed's got its work cut out for them. And right now, we're in the midst of earnings season. And next week, we're going to hear from the vast majority of S&P 500 companies. And one of the things we're looking for, and as an investment committee, is for the analysts to finally acknowledge that the economy is slowing to some degree and reduce estimates, because only after those estimates become more reasonable and realistic will people feel more committed to investing in the equity markets because they'll trust the E more than they do currently.
Commodity prices continues to be a story. What's the latest?
Commodity prices, generally speaking, have rolled over. I mean, oil prices are below $100 a barrel WTI. Gasoline prices are down 30 days in a row. So there's been some moderation there. But the key thing that my colleague Todd Voigt continues to point out is just because it's going down doesn't mean it's going to a new low. It's actually just remaining at a very high level. And wages are not keeping up even with those diminutions in price increases.
You mentioned earlier the consumer sentiment actually down a little bit. What about investor sentiment? I see a 15-year low.
Yeah, investor sentiment is as bad as they've seen at CNBC in 15 years. The only other thing I'd say about consumer sentiment is we did get a better than last month reading, and the key point was inflationary expectations do seem to be diminishing somewhat. So some green shoots.